I don't want to teach you something that happens once a week. You can't make a living off of that. I want to teach you something that will show up in your trading life every 8 minutes of your life. Every 8 minutes, you're going to see an elephant bar. Every 8 minutes, or a bottoming tail bar. You may not see both, but you're going to see one of these three things we're going to cover every 8 minutes of your life. That's how you make a living, by finding reliable things that happen with a frequency that can pay you every 8 minutes of your life. I'm talking about mastery, where you make money every 8 minutes of your life. You find an opportunity every 8 minutes. That's trading at the mastery level. The 8-minute trader is the master trader. The trader who can find money every 8 minutes of his or her trading life, that's mastery. The trader who's just profitable, there's a lot of them. But there aren't many traders that every 8 minutes they're richer. Every 8 minutes they have more. Every 8 minutes they pulled money out of the markets. And with these three, well, really with the 14, you really increase your odds. But today we're covering three. With these three, you should be able to get to the place where at least you identify an opportunity for yourself every 8 minutes. There are tails on the elephant and 180-degree turns. So we have an elephant with tails, with a tail that can turn around in a 180-degree way. All right? Now, the elephant bar, which I'm going to show you very shortly, comes in two forms. There is the bull elephant bar, which is an elongated green bar from high to low. Can it have a tail on top? Yes. Can it have a little wick on top? Yes. Can it have a little wick on the bottom? Yes. But the key thing is that the vast majority of the bar's range is green from high to low. Yes, it doesn't have to be all body. It can have a little wick at the bottom and a little wick at the top, but the vast majority of the bar's range is green. That's very important. And then you have the bearish form, or the negative form of that bar, which is a bear elephant bar. This is the bear version. Yes, you can have a little wick. Yes, you can have a little wick here, but the vast majority of this bar is red. The vast majority of the bar is body. This is not an elephant bar where you have half of the body is half of the bar is body and half of the bar is tail. That's not what we're talking about. We're talking about a full-fledged elephant where the vast majority of the bar's range is a solid color, solid green, bull, solid red, bear. Now, this can be somewhat tricky to determine, because what is an elephant bar for one stock at a high price is not, well, let me put it this way. An elephant bar for a low price stock is not an elephant bar for a higher price stock. So you have to basically judge what's an elephant by the bars before it to the left. So what are the size, traders, of the other green bars to the left of it, whether those green bars were yesterday or earlier today? What's the average size of the green bars to the left? And so as you can see, the average size of these green bars are much smaller than the current fat green bar, and that helps me know this is an elephant bar for this stock or this chart. Okay, so always look to the left. And some people ask me, Oliver, well, how far back do I look to the left? All you need is the most recent 10 to 15 green bars, right? Don't look at the red ones. We're talking about the green ones when we're talking about a green elephant bar. Look to the left. I'm going to repeat that again. Look to the left. I'm going to repeat that one more time. Look to the left. Look to the left for the last 10 to 15 green bars before this one. And if this one is much larger than the average of your last 10 to 15 green bars, you've got a powerful elephant on your hands. Now, it doesn't matter. Listen to me carefully. It doesn't matter whether or not this green bar is the first bar of the day or it is a bar an hour later after the market opens. It doesn't matter when this really happens at the current moment. We're not talking about time yet. So this could be the first bar of the day, and this was yesterday's data. And now we have the first bar of today, or this could be at this bar could be occurring at 10 a.m. Eastern time, and these were the bars before 10 a.m. All right, we're not talking about time, we're just specifically talking about event. Same thing for our bear elephant bar, right? Where you judge whether or not it has elephant qualities by looking to the left. I'm going to repeat that again. How do you judge whether or not this is tall enough and big enough to qualify as an elephant? You look to the left and you judge the by the last 10 to 15 red bars before this one. And if this bar is bigger, taller, fatter, more powerful than the average of your last 10 to 15 bars, then go. You've got a powerful elephant bar. Now, it should go without being said that when we have a powerful bear elephant bar, we are looking for follow through to the downside. When we have a powerful green elephant bar, we are looking for follow through to the upside. Now, let me give you some statistics, right? The follow through rate on elephant bars, 73% follow through rate. 73% follow through rate, which means that 7 times out of every 10, a little bit more, this will follow through. You will get more green after a fat elephant bar. 73% of the time, which means that a little bit more than 7 times, sometimes 8 times out of 10, sometimes 6 times out of 10, sometimes 9 times out of 10, but you're more or less 7 times out of every 10 times you see a bear elephant bar, a red bear elephant bar, you're going to get more red to the downside. So think of it this way. Think of it this way. Think of how powerful this is. I'm giving you something that has a 73% success rate, which means that when you see power green bar, there's going to be more green 73% of the time, which means that there's more money to be had 73% of the time, which means that you're going to win with this one bar strategy 7 times out of every 10. And you, with 73% success rate, you can make a living if you're in that percentile. Bottoming tail bars, whether it's a green top or a red top, right? Whether it's a green top or a red top, they have a follow through rate to the upside of about 70%. It's still high enough to make a living off of this one type of bar. It's okay. Let's get back. Now, the last event I want to cover with you is called the 180. This is when our elephant turns around. So the bull version of this is first you have a bear elephant bar that is immediately neutralized by a bull elephant bar. Boom. Now, what do I mean by neutralized? It takes out the high of the red elephant bar. Boom! Okay? That is the bull version. This has a follow-through rate. Now, get this. This has a follow-through rate to the upside. Get this. 88%. 88% follow through rate on this event. The bear version is the same. Okay? We start off with a green power bar. This is a power bar. And the power green bar gets decimated, gets wiped out, gets neutralized by an even more powerful red bar. What do I mean by neutralized? It takes out the low. Boom! It cancels out the opposite team. This green bar here cancels out the opposite team, the red team. It cancels its contract. Boom. This has an 88% follow through rate to the downside. Wow. Now think about this, guys. These three events are powerful because of their reliability. Do you understand? These three events, elephants, tails, and turnarounds, or 180-degree turns, right? Okay? These three events have such a high consistency rate. They have such a high follow-through rate that with these three, you can make your whole living in the markets. If you add the other ones, you just go over the top. But even with just these three, you can make your whole living in the markets. All right. If these things had a 20% consistency rate, then you couldn't. But 73%, 70%, 88% follow through rates. All right. So we're going to look at charts now, and we're going to look at example after example after example of these three things. It's important that you understand what they are. It's important that you understand or know how to identify them. All right. Very, very important. Elephants, bull and bear version. Okay. Bottoming tail bars. Well, remember the reverse of this. I forgot to actually list this. The reverse of your bottoming tail bar is your topping tail bars, right? Where you have the majority of the bar's range is tail, but the body is little. That's the pure. It doesn't matter what color the body really is. What matters is the tail, the majority of the bar's range. The color is of very little consequence. It's the size of the tail that matters. We like long tails. Not too long, but we want the tails to represent at least 80+% of the bar's range. And then, of course, why do I call this the 180? Because in truth, your stock is doing a 180 turn on you. It's an abrupt turn. First, it was going down, and boom, it reverses abruptly in a 180-degree fashion back to the upside. In the bear version, you're first powering to the upside, and then boom, the bears knock the green out of the box, and that 180-degree turn should follow through 88% of the time. What you see here is just basically a graphical indication of what a bull move is. It's just a strong, powerful surge to the upside. Or in reality, you could get a multiple bar run to the upside that represents the same thing. Both of these scenarios are bull moves. Both of them are powerful surges. Both of them count as practically the same thing. These are the three types of bull market moves. First type is a strong, powerful surge to the upside in the form of largely one bar. The period of the bar doesn't really matter. So if you're a 5-minute chart trader, this is a 5-minute bar. If you're a 2-minute chart trader, this is a 2-minute bar. If you're a daily chart trader, this is a 1 full day bar. Time doesn't matter. everything that I talk about is universal across all time periods. Of course, this is the reverse, 3 types of bear moves. So when I say look for a market move, you're looking for a market or a stock or a financial item that is producing either one of these 3 moves: a single powerful bar to the downside, a 2-bar power move to the downside, or a multiple bar move to the downside. There are 3 types of market pauses. Just like there are 3 moves, there are 3 types of pauses. So type 1 is literally giving back price, moving forward again. Type 2 is marking time, boom. Type 3 is just a brief pause. A pause 1 is a give back of price, remember? So we retrace a portion of that downward move, a brief move to the upside. And pause number 2 does not give back price, but it marks time. And pause number 3 is very brief, a hiccup. Boom! Broke my stride a little bit, but not for long. Boom! Got my rest. Now I'm off and running to the races again. Boom! Had to jump over a little small wall, so had to back up, and now I'm off to the races again to the downside. These are your 3 types of pauses. I want all of you, whenever you get a surge, I want you to break the surge up, at least mentally, into thirds. Even if you get the multiple bar run that represents the surge, you're going to think in thirds: top third, middle third, bottom third. In order to have a flag, we need, when the stock is ready to rest, when the stock is ready to pause, if that pause happens to occur in the top third of the surge's range, of the power moves range, if the resting period, if the pausing period, if the sideways motion, if the back and fill, the consolidation period stays trapped in the upper third of that move, you've got something like an 84% chance. Boom. This happens. Now remember, this power move, traders, can be multiple bars as well. And so if we were to draw that in, it could look something like this. Boom, boom, boom. And then, all right, in this scenario that I've drawn here, you are in the top 1/3 of that multi-bar run-up. A stock must rest after a power move. If it doesn't rest, it's going to run out of gas, and continuation of that power has low odds. When your stock is resting sideways, you need it to stay in the top third. But if it rests downward, you need it to stay in the top 50%. If you break this 50% mark, now any move up is likely to fail. If you don't break the halfway mark, the move up is likely to go to new highs. The new high here is closer to 70%, maybe even a little bit less, like 68, 69, but let's round up to 70. To make a new high, my stock now has to travel. Bad drawing there. travel, and now make the new high. By the time it's making the new high, it has already expended energy. It's already put effort in. And by the time the new high happens, a portion of its energy has been spent. Okay? However, in this scenario, when you are making, boom, this new high, it's just beginning. You see the difference? So this new high is fresher than this new high because the run started from here versus, in this case, the run is starting from here and is still fresh at the breakout point. Not so much energy has been expended to get to the breakout point. And so this follow through rate is higher than this follow through rate because of that reason. This is not the drift sideways, which we know has to stay in the top third. This slows down the momentum, but slows down in a drifting upward way. This still expends some energy. This expends no energy. This expends some, but very little. And this is still expending energy a little bit. So what potentially can happen here is this. This can happen and still be bullish if you don't break back below the top third. So if this drops like this, that's still okay. But if the drop breaks back through the top third of the initial power move, it's over. Now rallies will likely fail. Here's pause number one. This is one move, interrupted by a pause. Here's move number two, interrupted by another pause. Remember these two pauses. Here's move three that is more likely now to have some type of change. Why? 3 legs have been achieved. 70% of your turns change after 3 legs. Let's look at 3 legs on the downside. Move one, pause one. Move 2, pause 2. Boom! Move 3. The 3 legs. Sometimes it produces a 4-leg animal. Sometimes it produces a 5-leg animal. But most of the animals that the market produces have 3 legs, 4 legs, or 5 legs. 3 legs up to 5 legs. First, every bar starts off with a dash. That's the first transaction. In this case, BABA began to actually move to the upside. So I'm going to make that green. We're watching BABA gap up to the upside and gap up way above its key moving averages. Okay, so it's gapping up way above its key moving averages, and it's already far away. It's extending the distance away from the key moving averages by moving up additionally to create that bar. This bar sometimes can lead to greater upside, but sometimes this bar can lead to downside movement. So if that bar forms near your moving averages, the odds are that there will be more upside. Okay, note here that this fat green bar happens close to one of the key moving averages, and there was more upside. But this green bar quickly gave way. Why? Because it has formed far away from the key moving averages. Okay, so that's the difference. If a fat green bar forms near your key moving averages, the idea is that this bar has a higher probability of carrying forward, following through to the upside, continuing its nature. But if a fat green bar forms in an extended position, far away from everything, I call it Pluto land. It's far out there in outer space. That green bar will likely give way, or at least we're closer to the end than we are to the beginning. This bar becomes fat green. Now, there was no red there yet, but what begins to happen? This bar, 25% of the bar starts to disappear. So now you have a bar like this. It's green, but it has a little tail at the top. Then 25% of the bar disappears. Now the bar looks like this: half tail, half green. And eventually all of the green disappears, but this bar looks like all tail now. It's 100% tail. So we go from all green to some tail, but mostly green. Then we go to half tail, half green, and then we go to all tail. When a green bar, a fat green bar, extended well above its key moving averages, if that fat green bar gets removed, boom, 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 that's when we jump into that bar with a short position and a protective stop above the high of the bar. Why are we betting to the downside? Because we're betting that this far distance away is now going to be brought back to near. The no follow through event that I want you to be aware of comprises of a fat, sizable red bar. This bar has zero red after it. Now, let me tell you why that's significant. A fat red bar, 83%, 82, 83% follow through rate. Think about this, guys. 82 to 83% of the time, another red bar follows a fat red bar. That's how reliable these bars are. But in this case, this is the exception. There is no follow through. The next bar is green. There's no additional red. Like what? Then the next bar is green. What? Okay. That's still not the special part. The second special part is that the red bar to the left gets totally removed. So the three things that I need you to know that makes up this event: fat red bar, 1. 2, zero follow through, no additional red, 0. And 3, the green completely erases, completely recoups, completely neutralizes the red by trading above the red bar. That is a major bottom. You can't have a former peak until you have a pullback. The pullback is what creates the former peak or the prior high. What I mean by a new high is this: a move back past and through the former peak. What I'm telling you is that 72% of the time, this new high will fail. 72% of the time. Let's say 28% of the time, you're going to get continued follow through on that breakout to a new high. What do I mean by new low? Just the reverse. You've got a strong move to the downside or a decent move to the downside. This is a multi-bar move. It's not one bar down. It's multiple bar down. Now, you need a retracement in order to have a prior low, to form a prior low. What I'm saying is that 72% of the time, this new low will fail, meaning that there won't be follow through. 72% of the time. 28% of the time, there will be. It is better to actually go the other way on every new high. You'll be right 72% of the time, and you bet against a new low, and you'll be right 72% of the time. You're going to lose 28% of the time on average, but you'll win 72% of the time. This by itself is a winning strategy. Going against, being the contrarian and going against every new high and every new low. Now, I'm not suggesting that you do that, but I am making you aware of how powerful a 72% reality can be, that it can make you automatically profitable by doing it every single time. This leads us to having to know our proper percentages. All right, so I'm going to teach you proper percentages, which are going to give you, these percentages are going to give you the ability to determine what's the likelihood that this move to a new high is the 28% that's going to follow through versus this is one of the ones that are going to fail. So we need, in order for me to bring you to that ability, to create that ability in you to be able to say, that's one of the 28% that's going to keep going. Now, this is one of the 72% that's going to fail. In order for me to get you there, we have to first understand our percentages. Okay, so let's go. If your pullback stays in the top 33% of the strong move to the upside, this is likely to be one of the 28% that keeps going and going and going. And this pullback, it passes the third mark, but it doesn't pass the 50% mark. This has odds of being one of the 28% that will keep going. So the first two percentages in terms of pullbacks, in terms of the stock rallies and then starts dropping again. If the drop is milder than the rally by 1/3, and then we break to a new high, that new high is likely to keep going. If the stock runs up in the second scenario, pulls back a little deeper than 33%, but does not really exceed the halfway mark, that still kind of falls into the 28% camp of breakouts to new highs that can keep going. We drop past the 33%, we pass the 50%, and we drop into the 66% zone. Now, when this attempts to rally, if this manages to break that high right there, boom, that's likely to fail. This stock comes from 66%, runs past 50%, runs past 33%. By the time he gets to the new high, this stock is like this. Boss, did I run well enough? A lot of times traders are just automatic buyers of new highs. Now, this piling in at this tired point is what creates the possibility of a violent reversal back to the downside, because as this tips back below the new high point, everyone who piled in here is a loser. 100%. We're covering the 100% version now. So we've rallied, we pulled back, we've passed the 33, we took the 33 out, we've passed the half, we've taken the half out, okay? We've even passed the 66%, we've taken the 66% out, and we've gone all the way back to the origin area of the initial move to the upside. This is your origin area. That's a 100% retracement. If this manages to turn and be strong enough to get all the way back, I am telling you, 8 to 9 times out of 10 in this case, that's a powerful failure. If the stock is tired by the time it gets to a new high after a 66% retracement, imagine how tired it is after a 100% retracement. I want you to understand that if this stock, the odds of this stock, if it bounces, the odds of it getting all the way back to the 100% mark, we know that if it does and breaks out, that the odds are that it fails. But the odds of it getting there is 1 out of 10. You will see a stock come all the way back to the 100% mark after a strong, powerful drop, that'll happen 1 out of 10 times. What's the odds that we get? So the odds that we get all the way to the 100 is 1 out of 10. But what's the odds that we get not to the 100, but the 66? 2 times out of every 10. What's the odds of this stock bouncing back to the 50% level? You jump to 6 times out of every 10. What's the odds that we bounce back? Let me do that in the same color. And we bounce back a third, 8 to 9 times out of every 10. It's like 8.5. That's why I say 8 to 9. That's crazy. On the reverse side, right, guys? So we have a strong power move to the upside in the form of 1 bar or in the form of multiple bars. It doesn't really matter that much. And let's put our levels in, right? There's the 33%. Here's the halfway mark. There's the 50%. We're talking the same thing. 1 out of 10. Hope I'm not in the way with this. The odds of us getting to the 66% is 2 times out of every 10. The odds of us getting all the way back to the 50% jumps quite nicely to 6 times out of every 10. And the odds that we get at least a third pullback, the odds really go ballistic to 8 to 9 times out of every 10. A move up from here is highly likely to make a new high and keep going. The move up from here is also not as high, but it's still high enough to make a new high and keep going. The attempt from here, if it got to a new high, is likely to fail, but the odds of it getting to a new high is very low. So what is this likely to do? Do this, rally and drop. This one, the odds of it getting all the way back to 100 retracement or new high, if it did, it's going to fail most of the time. But the odds of it getting there is very low, 1 time out of every 10. So what is this likely to do? It's likely to bounce and boom, make a new low. So the new lows that work come from these levels. To be able to say this bounce is not real and should now move to a new low. The ability to do that is so powerful and profitable. The ability to say this bounce is not real. We're going to new lows. Do you know that that is like a money machine? It's very powerful. To be able to say this pullback is not real. This is going to new highs. Boom. To be able to say that we should make new highs from here. Boom. To be able to say this move is not real. This is a fake out move to the upside. We're going lower. Why? Because you hit the 66% level. That bounce should fail. To be able to say, this bounce is not real, I don't believe it, it's going down again. Why? Because we hit the 100 level. Boom. Knowing when to say, we're going higher. I know it's pulling back, but we're going higher. And to be able to say, you know what, this move to the upside is false. I'm not getting caught in that move up. I'm not placing my faith in that move up. We drop to the 66% level, more or less. No, that move is false. These are the three most prevalent ways that markets bottom. It's that drop, that collapse into a low, and a roaring back of the low to leave behind a V bottom. This, I must tell you, is the rarest of the three. This type of bottom, which actually was the predominant bottom back in March of 2020 for most financial markets. This bottom does not happen as often as the other two bottoms I will explain. This bottom is the rarer of the three, the higher foot bottom. This bottom works like this, where you have the stock is making a series of lower lows. So remember, criteria number one, declining stock, declining 20. Criteria number two, break through the 20 for the first time. Criteria number three, pull back, and boom, a higher foot. Here's the left foot. Here's the right foot. So guys, remember, when you have an even foot, it looks something like that, which we're going to go over actually. Left foot, right foot. And here you have left foot, right foot. It's on a slant. All right? Left foot, right foot. Left foot, right foot. So it's downward. Left foot, right foot. All right? Here you have left foot and right foot. You see? Okay. And then you hear, but for the first time, you have left foot, and the right foot is higher. So now, if some of you will recognize this sort of like as a reverse head and shoulders pattern, but I think that's a little too involved. It's not necessary. The first right foot that's higher is the sign that you've bottomed. The first right foot that's higher. Your right foot wasn't higher here. Your right foot wasn't higher there. Your right foot wasn't higher here. But all of a sudden, your right foot is there. But not any right foot that's higher. The right foot that's higher, that's following the first break of the 20-period moving average. But it's not as certain because this move up didn't get through the 20. I like them best when the move up changes something as well as the move down changes something. See here, the move up is changing something. That's my first warning. Now, once it gets through that 20, I'm saying, wow, I'm going to watch the next pullback, because if that pullback stays higher than the prior left foot, boom, I'm in on the next color change right there. Boom. We break through, we pull back, and right here, if I get a key solid color change, what's that? Green takes out strongly a red. Boom. Right there. The clearing bottom, guys, is, remember I told you that the initial bounce is usually not real. This usually falters. But if this goes sideways after that initial bounce, and you attempt to move up here, and this move clears 5 bars to the left, this is what we call a clearing bottom. This is very different. There's your V bottom, there's your higher right foot bottom, and then there's your drop, drift to the side, boom, clear bottom. Now, what makes this so powerful is that it has gotten away from the trouble. I'm only doing it just because I wrote it wrong. Really, what should be here is what I call the market law for bottom. ML stands for market law for. I have a variety of market laws that I teach my traders. This is one of them. It's actually market law number 4. It's a market law number 4 bottom. Here's how it works. It's very similar to the higher right foot bottom, except that the market law 4 bottom is a series of lower lows, and instead of the higher foot, you make a relatively even low. So it fails on this pullback to make a significant new low. This or this. This is the higher right foot bottom. This is the market higher right foot bottom. And this is your market law 4 bottom. They're kind of variations of the same bottom. One just fails to come all the way back. Do you understand? Now, what I like about the market 4 bottom is that that you don't miss it. That it's come all the way back to the low. It has failed to make a new low, but you need something powerful here. You can't guess that that's the low. You can't try to catch a falling knife into the prior low there. You must have something powerful. A powerful green bar, a powerful color change, something powerful, something big, something bold must confirm this bottom is in. You don't just guess. All right? Because if that was the case, you would have guessed here and failed, and you would have guessed here and failed. You need something powerful that confirms the turn. Power green, power color change, power tail bar, power, bold, oomph. Nothing like, hi, Oliver. Nothing like that. We need it powerful. Okay? Okay, now, let's summarize. And then I'm going to go to charts here for you, right? Let's summarize. We've got 4 now because I messed up, but okay, to your benefit. So we got 4 now. We got the V bottom. That's your V bottom. That is the rarer of the 4. All right, let me draw that again. So you got this. Stock's been trending down. Boom, V bottom. Okay, now there are ways, I can't go into that. It's beyond the scope of our live event here today. There are ways that I teach my traders to grab these V bottoms because they're hard to detect. There are ways, but it's beyond the scope. But this is the rarest of the 4, right? Then you have your higher foot bottom. Now let's do that like this. So you're dropping, you're dropping, you're dropping, you're dropping. All right. You break through that 20, you come back, you create a higher foot, boom. And then you have the market 4 bottom, where you rally, you pull back, it could make a new lower low, boom, it doesn't make a new lower low. Market law 4 bottom. So let's do higher right foot bottom, market law 4 bottom. Okay? And then, of course, the one I told you about, let's do the V bottom here. And the one I told you about, right, that I wasn't supposed to tell you about was this one. Boom. That's your clearing bottom. A stock opens for the day here. Let's say we're assuming a 2-minute time frame chart, all right? It drops from the opening price, it just drops really fast. That means it's creating space. Let's say it started at 40. Down here, it's at 38. All right? It created space, remember time is space, it created space faster than it created time. So if I take the space axis, which is here, 40 to 38, that axis is taller than my time axis. So my time axis, if I were to put these side by side, there would be one axis that's really short compared to another axis. So my space is longer than my time, which means that if my stock attempts to bounce from here, it will likely be a failed bounce because it's bouncing from a non-equal state regarding space and time. So this attempt to move up is a failed attempt most of the time, not all the time. Nothing can be all the time in life, okay? Most of the time. This rally from a drop that has the space long but the time short will usually create a failed scenario. Now let's take the same space drop from 40. All right, we're going to take the same space drop from 40 to 38. We're going to create the same space. And yet, what we're going to do, though, is that space is going to be accomplished with time. And so now we've got the same drop in space, okay? But the time is starting to become equal to the space. And so any attempt here to move up is more likely to be real because my time axis and my space, they don't have to be perfectly equal, but they're more equal. This kind of drop, the beginning, end, did not, the space and the time are too off. So now, boom, that move up is going to be fake most of the time. Versus this move up is likely to be more real. Boom. Now, let's take this version of space and time being relatively close to the same size, okay? Let's take a scenario where the drop is sharp. So here's the drop is sharp, and here the drop is more gradual, right? Well, there's a way to get space and time equal with a sharp drop as well. Let's go over that. So you can have this scenario where you drop hard, you have this fake out rally, boom, fails, but this next move down gets you the time. So here's your time axis. Here's your space axis. You see? And your space axis and your time axis. But this move up was the fake one you don't believe because the time was too short. But this one is the one you trust because time has grown to be relatively equal to the space. In order to know locations, we need two moving averages. All right, these two moving averages will be forever on every single chart, every single time frame you ever look at. It's the 20-period simple moving average and the 200-period moving average. We have the 20 and the 200 overlaid on our 2-minute chart. And they're both, notice how the 20 and the 200 are relatively flat and close together. That's important. When you have these two moving averages relatively close together, the location right above them, OMG. Let's just put it, OMG. This. You build your house there, and you can name your price. Do you understand this? There is no location better than number 1 here, right above your two main moving averages, the 20 and the 200, when they're flat. Okay? Best location. Second best best location on the downside is right below the two moving averages. So we want bull events here, right? We want bull events here, and we want bear events there. So I want bear elephant bars here, and I want bull elephant bars there. Okay? So above the moving averages, we want to go long, so we want long or bull events. Under the moving averages, right under, we want bear bars so that we can play short. Now, if we get the opposite bars there, we do nothing. So if I get this bar here, like this, I do nothing here because I don't have a match. This is my bull territory, and this is my bear negative territory. I want red and bearish there, and I want bull, green, and bullish there. If I get a mismatch, I'm sipping coffee. Okay, this is what I'm saying. If we're right above the moving averages, we're going long. If we're right below the moving averages, we're going short. Okay? This is your best location. All right? The order of the moving averages don't matter. So notice how in this scenario, the 200 is above the 20. All right? Here's the 200. It's above the 20. Doesn't matter. In this image, I have the 20 above the 200. It doesn't matter. It's not whether one is on top of the other or not. That doesn't matter very much. What matters more is, are they both relatively flat, and are they both relatively close together? What's location or neighborhood number 2? If you can't get, sometimes the market's not going to give you neighborhood number 1. You're going to have to look at maybe neighborhood number 2. Now, this neighborhood number 2 is in the wide state. So remember, the other neighborhood or location was in the narrow state when they're both together. Well, what about when the 20 and the 200 are wide apart? There's a neighborhood up there too. This is neighborhood number 2. This is location number 2. Now, in the wide location, this is where your 20 is wide apart from your 200, and the stock is above both of them. Okay? Now, from this location, you want to play down most of the time. The reason you want to do this is because markets vacillate between narrow, see here, narrow, wide, and then back to narrow. Narrow, wide, and then back to narrow. So if you're up here, what's next? Back to narrow. If you're down here, what's next? Back to wide. Now, you can also go from narrow to wide this way. Boom. See? And so, check this out, guys. We want green here or red there, right? Red there, right? Red there. Or we want green here or green there. So we don't have to know which direction the market's going to go. We need to know what does it give me an event here? I'm buying. Does it give me an event here? I'm buying. Does it give me an elephant or dual tails or bull 180 there? I'm buying. Does it give me a red elephant here? I'm shorting. Does it give me a bear 180 here? I'm shorting. Does it give me dual topping tail bars here? I'm shorting. You don't have to read the future. You have to wait for the now in the right location. And if I'm going to go down from here, does the market give me right here, does it give me a bear elephant bar? Then I'm going shorting. Does it give me a bear 180? Boom. Does it give me dual topping tail bars? Boom. So neighborhood 1, neighborhood 2. Okay? Neighborhood 2. We're looking to bet down to bring us back to a narrow state. There's this the wide state location at the bottom where your 20 is wide apart from your 200. Your 20 is wide apart from the 200. And you're looking to play up, back up. Why? Because markets vacillate between narrow, wide, back to narrow again. So if you're already wide, the odds are better up. Okay? So I want bull elephant bar down there, bull 180, bottoming tail bar, dual bottoming tail bars. Right? Know what locations to play your plays in. So this is the summary of the locations, guys. We've gone, if you're narrow, you're playing these locations. If you're wide, you're playing the opposite locations. You're playing wide back to narrow or narrow back to wide. Ones are narrow back to wide. So in location 1, if I get a bull elephant bar right above this narrow state, or a bear elephant bar right below, I know that this is extraordinarily high. Now remember, if I got the right location, I'm 80%. I'm going to have wins of 8 times out of every 10 from this location. I'm going to have wins statistically 8 times out of every 10 from that location down. If I play here in location 1, any tail bar combination, I'm extraordinarily high success rate. Topping tail bars from that location, high success rate. Bull 180 from that location, really high success rate and very powerful. Bear elephant bar from that location, powerful. All right? Remember, flat moving averages. If my moving averages aren't flat and they're really wide apart, I am looking to go the other way, back to narrow. But I need a bullish event down here. I need one of my bullish events. Remember, you're never playing anything that's not an elephant, a tail, a 180. There's nothing else to play. Here is the opposite. We're not narrow anymore. We've gone way wide, and I get a bear event wide apart here. Boom, I'm betting down. Boom, I'm betting down. Boom, I'm betting down.